Hello, everyone. Today is Thursday, April 21st, 2016. This is the week in charts. Brought to you by, once again, WalkingSquirrelCoffee.com. I had some Costa Rican this morning, and it was quite excellent. I think it might be my new favorite. I don't know. Every time I try one, it's my new favorite. It's all good. Anyway, it's also brought to you by me. I guess I need to update this graphic. This is for my trading service. We're going to take a look at the portfolio in a few minutes, not just because I'm proud of it, but also because it has a lot of good learning and teaching examples in it. So we'll take a look at that in just a second. And you can just go to davelandry.com's trading service, or just go to the store, and you can get to it from there on my homepage. There's a disclaimer screen. As you know, you can lose money trading, or as I like to say, borrowing a line from my buddy Greg Morris, all predictions about the future, and a lot of stuff can happen between now and then. Let's just jump right into it. Last week, I began my discussion on the art and science of setting stops. We talked about three things: how long you want to be in the position, how volatile is the underlying instrument, and where would you be obviously wrong. And where would you be obviously wrong is from a technical analysis type of standpoint. Uh, did the Would the trend end if it went this far against you? Would the trend be reversing if it went this far against you? For instance, if you're trading an emerging trend and you're buying a stock and it goes down and makes new lows, and obviously you're wrong. So we spent a lot of time talking about that last week, and we just kind of touched upon 1 and 2. So this week I want to expand upon 1 and 2. Now, I did a video, a similar series way back in 2015. So if you want to go and watch those, if you go to my website under videos, which you can click on the home page, there's two right down here. You have to scroll down into how to. There's so many videos on this page that it's beginning to slow down in the loading, so be patient when you go to load that page. But there's two videos down here, 129.15 and 2.5.19. You might want to watch Shia LaBeouf, get you motivated to trade. I hired him as a motivational speaker. It was pretty interesting stuff. So check that out too while you're there. Although I spelled LaBeouf wrong. Anyway, also last week, if you look at the top of the page, somewhere up here, if you scroll when you first loaded, you'll see last week's a week of charts. And that was the first part of this stop series. So check those out as you have time. Also, on my YouTube channel, I often touch upon a lot of these things, so make sure you join the YouTube channel while you're there. Now, getting back to this discussion on stops, the question you have to ask yourself is, how long do you want to be in the position? Now, I'm going to talk quite a bit about my hybrid approach in just 1 second. But my goal is to withstand a short-term move and then hopefully hang around for a longer-term move. But if you're planning on staying with a position for a long, long time, that stop is going to be higher and higher and higher, because the further you go out in the future, the more that stock or any other underlying market can move. Now, this is a volatility projection. This was created in Metastock, and this is using a 50-day historical volatility, HV, look back. HV is also known as statistical volatility, and I'm going to talk a little bit more about that in 1 second. Don't let the name of it scare you away. I really don't fully understand how it's calculated or how it works, and I'll explain what little I know about it in just a few minutes. It's like electricity. Although I do my own electrical work, which is kind of scary, I guess, if you think about it. But you don't have to know how to wire things in order to flip a switch and get some light. You don't have to understand how it works. It just magically works, right? So the point is, the further you look out, notice that this parabola, which is just a statistical measurement, it just measures statistically the changes back here, and it projects them forward. Now, one thing, and I don't want to get too far into this, but one thing you got to be careful about with markets is markets are not normally distributed. Well, what does that mean? Well, it means they don't adhere to statistics. Casinos are normally distributed. They know that provided their dice or to certain specifications or whatever, they know that there is a 1 in 36 chance that you might roll a certain combination or whatever the case may be, and they got the games figured out accordingly. Their roulette roulette, what do you call that, a table? The roulette table is precisely calculated to randomly drop the ball in so many slots, and then they have the little edge on top of you. The O and the OO on that gives them their little edge. So it's not a fair bet. There's no bet at a casino that's a fair bet. And they know that they might lose over the short term, but longer term, the statistics will kick in. Okay. In markets, it's a little bit differently. Markets aren't normally distributed. Talib has done a lot of work on this. I read his books. They're kind of depressing, but read them anyway. I don't know if he has books. I don't know he has a book. I've got it here somewhere. I forget the name of it, but he talked about the black swan quite a bit. I didn't think I'd back into the Talib discussion. But Talib's point is just because you've never seen a black swan doesn't mean they do not exist. Well, I had one land in my pond once, and that was out of the blue. And I just so happened to be having a pretty serious drawdown at the time. I think it was a bit of an omen. And then recently I was walking around the block, and I noticed I heard some honking, and I looked over the fence and at a neighbor's house, and they have some swans. Some of them are black. Anyway, Talib's point is just because you've never seen one doesn't mean that they don't exist. Well, just because you've never seen a big market move against you, an adverse market move, doesn't mean that it exists. Now, those moves occur a lot more often than they should based on the normal statistics. Now, before we back too far into that, the point is the longer you intend on staying with the position, the wider your stop will have to be, because this parabola gets bigger and bigger and bigger. All predictions are about the future. A lot of stuff can happen between now and then. Or as Yogi said, predictions are tough, especially about the future. So here's the thing. The real money is in longer term trading. The real money is in longer term trend following. Unfortunately, that's where the risk is. So the longer you're in a position, the better the chance of something bad could happen. Now, let's just back up just for 1 second here. Let's say if you're scalping, meaning that you're in and out all day, which I recommend that you don't do, okay? But your stop might be way back here. You might be able to use a very tiny little stop. Let's say you want to hold on for like a year or longer, well, then your stop may be way out here, okay? So if you're scalping, you're just trying to stay outside of a very small period of time, a few minutes to whatever. But so you could use a very tight stop and withstand that noise over that period of time. But the further out you go, the more risk they will be. Now, back in my mechanical programming days, or back when I was trying to program mechanical systems, I should say, I actually succeeded in programming them. I programmed several thousand of them. Keep in mind that a lot of those are just variations on one particular theme. So I might have 10 systems just on one little particular theme and changing parameters, but it was several thousand altogether. And early on, I was a big fan of accuracy because that seemed to be impressive. And who doesn't want to just make money, push a button, get a peanut, you know? But I quickly found out that a lot of those type of systems are anthill systems. So I could write you a 90% correct system. That would be pretty easy. But if you tried to follow that system, you'd make a lot of money probably for a while until it blew up. And that's the problem with these anthill type of systems, so-called anthill, because like an ant's building a little hill, little piece, little piece, little piece, little piece, little piece, and then a big footprint comes along, bam, wipes it all out. Then you got to start all over again. The real money's in the longer term trades, but you could only predict the short term, and your shorter term trades are less risky. Now, here's the other unfortunate thing, which I was kind of hinting about with the 90% or so-called like income producing systems. That's fine and dandy until they blow up. But even as a short-term, let's say, swing trader, and you're just saying, well, I'm only going to stay in the market for a few days at a time, get in, get my piece, get out, get in, get my piece, get out. And I started sort of off of that as that kind of trader, but I quickly realized that the real money was being made longer term. Unfortunately, shorter term was a lot more accurate. Longer term accuracy was so low that it's nearly impossible to trade that way. It's upwards of 75 and probably more like 80%. I think 78% is the number that comes to mind back from all that testing I did years ago. So short term makes a lot more sense. You can only predict the short term. You can only look so far out. It's akin to predicting weather. I'm looking out the window right now. I see some clouds beginning to form. We might see some rain later today, but I don't know if it's going to be raining this time next week or a year from now. The problem with the short-term trading, though, is that something bad can still happen. You can still have that black swan event come along and wipe you out, okay? And it might not wipe you out, but it'll take away enough profits to where you really got to work hard to make those profits back. So you need the occasional longer-term winner to help pay for it all. And that's where the real money is. So the short-term trades that we take keep the lights on, but we hold on to a piece for hopefully a longer-term gain, and that's where the real money is. So the idea is obviously to change hats from the trader to the longer-term trend follower. We all read about these long-term trend followers, but what you fail to realize, or what they fail to tell you, is a lot of them subsequently blew up due to the amount of risk involved, because the further out you go, the wider the stop has got to be in order to ride out those moves. And the drawdowns are absolutely abysmal. So we're going to switch from being a trader to a trend follower. Now, I don't want to get too far into the money position management, but it dovetails nicely into the volatility speech on setting the stop. So if we enter our little pullback, we got a nice little trend, nice little pullback. We're into the pullback. We place a protective stop, and we're trying to get a swing trade. So whatever this distance is, we're looking for this distance up here, and we're going to take that additional profit. The beauty of that is if we're able to squeeze that trade off and get that additional profit out, and I'll show you a live example in just a few minutes. If you could do that, then you're in a wonderful place. Then you could change hats to the longer-term trend follower. In that stop that you've been kind of ratcheting up, stair-stepping up on a one-for-one basis, you could let that open up and then ride out a longer-term trend. You've already taken half your profits off, so the worst thing could happen, barring overnight gaps, is you stop out at a loss. And as you move above your entry, the worst can happen, barring overnight gaps, you stop out at a break even. And the worst you could do once you get above your entry would be to stop out at a profit. We had one stopped out of profit yesterday. That's okay. That's what we get paid to do. We get paid to put capital into harm's way, and we know we put in capital into harm's way, he tried to say. So we take those partial profits out, and then we trail a stop. Hopefully, and I hate to use the word hope, we're with it for a long, long time, and eventually we'll get stopped out. And if it's at a profit, then we say so long and thanks for all the fish. Now, again, you have to also ask yourself how volatile is the underlying instrument. And the more volatile stock is, the wider your stop will have to be. So it's a combination of time combined with volatility. So again, getting back to our volatility projection, and I don't actually use these in my actual trading. I think this is what they call an odds probability cone. The options people sometimes use them. But if these swings were bigger than what's shown here, if they look more like this, then this parabola is going to be much, much wider. So volatility plus time equals stop distance, okay, or potential movement in the market that you have to withstand. Now, regardless of how long you want to be in a trade or your time frame or whatever, you have to withstand the normal volatility within that time period you're looking to trade. So if you're a swing trader, you have to withstand at least the 3 to, let's say, 10-day volatility of a market, because you're trying to get that swing trade off, and you're trying to get that profit off within that period of time. If you're a longer term trader, then obviously your stop's going to be really, really wide based on that noise. So our goal, and I don't want to back too much into the money position management, but it all intertwines and dovetails together, so it's hard not to. But our goal is to put on a big enough position to where it's still big enough for the longer term trend following to pay off. Okay, because if you try to go in and take that big position in a longer term trend following position, then your risk would be so great, and you've got a 70% chance or more of getting stopped out. So there's a good chance you can blow up your account if you did that. So if you traded a smaller size, your position would be so small it'd be meaningless. But if you're trading a somewhat bigger position size for that short-term trade within the short-term volatility, and you take partial profits, then you have a relatively big position still on for the longer-term trend following, and you still will get paid in that. A lot of people are like, well, Dave, you got your smallest position on for your longer-term trend. Well, that's okay. That's no problem there, because if you have on too big a position, then, again, your drawdowns are going to be abysmal. And drawdowns are tough from a psychological standpoint. I've backed into money management here, and I certainly don't want to get into psychology this week. But if your stop is somewhere within this normal noise, you're going to get stopped out on noise alone. And again, I'm going to preach this point quite a bit today, as I often do. Your best ally is just looking at the chart and using some common sense. And that's going to keep you out of a lot of trouble when it comes to setting stops. So you don't necessarily have to really get into ATRs or all of these other type of things when it comes to setting stops. Now, last week we took a look at the open portfolio, and I have it again this week, and I want to show you a couple things in here before we talk about stops and ATRs. So we've got these fairly wide stops on these positions, but that's what it calls for, okay? The stock is only $9 a share. It's a 3-point stop. That's like 30% round numbers. That's pretty incredible if you think about it. But that's what it calls for. You have to be outside of that normal volatility. Like I said last week, 30% stop. I can't use no 30% stop. Like they said in Caddyshack, oh, well, you ain't getting no Coke. Okay, so you're not going to be able to capture these wonderful moves in these wonderful markets. Right now, energies are volatile coming off of these major lows. And all these metals are mining. The moves have been really volatile. These stocks have been really volatile. So you'd say, well, I'm bullish on the metals and I'm bullish on the energy stocks, but you know what? I can't use no 30% stop. Obviously, I'm using bad English to make a point in case my wife's watching. Anyway, so like they said in Caddyshack, well, then you ain't getting no Coke. So the point here is that more volatile stocks within reason offer better opportunities. On last week, I started writing my column for Friday, and I was taking a lot of things I talked about and setting an initial stop based on the structure of the market, where you would be wrong, number one in that list of things. And I started digging around looking for some backup material, and I stumbled across an article that I did for Traders Magazine. And it was Understanding a Stock's Volatility Better than the Devil You Know. So if you go to my website and just scroll down to content on the homepage, you'll see that article right there. So I would suggest you read that, and my point is that a more volatile stock is actually, within reason, a better stock to trade. Now, if you have crazy volatility, Dave, what's crazy volatility? Well, anything over 100 HV, you've got to really look hard at. Anything over 150 HV, as a general statement, you probably should toss it out, okay? Because it's so volatile that even if you think you've got a really wide stop, it could easily still stop you out and take off. Again, remember, those statistics, when it comes to markets especially, are worthless, and statistics are worthless. So 75.3% of all people know that, right? So check out that article after the show. And this was my point last week, and then we're going to take a look at ATR on this. I promise I'll get to that. But we had a stop set at 34%. Well, in hindsight, that doesn't even look like that wide of a stop, okay? Because it's really not that far below this little pullback in here. But that's what the stock called for. So we took profits at 34%. And then, knock on wood, we're in longer-term trend following mode. We'll take a peek at the portfolio in a second. And hopefully we've changed the hat. Well, no hopes about it. We've changed the hat. We've changed our hat from the swing trader to the longer-term trader. So now our stops are going to be maybe even wider than 34%. Okay, we're certainly no closer than 34%. So that sounds kind of crazy, but that's what it calls for. In fact, if anything, as we look at this next slide here, looking at the same stock, this volatility, HV, has maybe gone up since then. I don't know. I don't remember being 91 when we got in. I should have checked that, but I forget. If anybody knows what it was back here, let me know. But I think it was pretty high because of the move in the market. Now, notice that our stop was 3.15 points away for a $9.15 stock. That seems like a lot, but this move here, as you can see, is more than 3 points alone, just to this little pullback. And then by the time you get the entry in here, which was up here, so 3 points really wasn't that extreme when it comes to this stock. And again, going back to the prior slide, it really wasn't that far below the pullback, okay? Now, here I have an ATR plotted, and if I did it correctly, this actually comes to like what's considered a 6-period ATR. And again, let's not get too caught up in the math, but it's number of periods minus 1 divided by 2, I think is what it is. I wanted to get number of periods divided by 2 minus 1. I was looking for a 7-day, but I ended up with a 6-period. Close enough for government work. So the only problem with statistics is you have to just kind of take them with a grain of salt, and it actually just the opposite happened this time. A lot of times my argument is when you're trying to use a statistical measurement, your stop is so wide that you're outside the normal, you're way outside the normal volatility. You're so far outside of it that it's just too wide of a stop. But in this particular case, it's kind of interesting that this is actually within the normal volatility, and you might have gotten stopped out using an ATR in here, because right here you had less than a 2 ATR, and notice that this little pullback here was 2. This one right here was 2.75. And look at where your ATR was down here. Your ATR was actually decreasing. So it's okay to use a statistical measurement like ATR, but just kind of take it with a grain of salt and go back to number 1 that we talked about last week. Ask yourself where you'd be wrong. And then number 2 and number 3 this week is, where would your stop have to be to ride out that short-term volatility? And then how are you going to open up that stop longer term to ride out the longer term volatility? Now, I don't want to get into the nuances too much, but also you have to know this is where it gets a little tricky once you start using statistics in the markets, because what's going to happen is that volatility might drop off like it did right here. Notice how this volatility actually absolutely began to implode. So if you go to trade this stock, you might think that you could use a very tight stop. Now, if you're looking at the 50-day volatility, like, well, hold on, Dave, that's pretty high. I know I can't use a really tight stop with a volatility approaching triple digits. But keep in mind that volatility does wax and wane. And in fact, if anything, after the volatility begins to compress, volatility begins to take off again. So be really careful if you see a low reading in something that normally has a fairly high reading. So you could use these statistics, but just take them with a grain of salt and just eyeball a chart and look at them. Often ask this webinar almost weekly. Hey, Dave, do you use ATRs to set stops? No. But if you boil it all down, I'm using an ATR, but I'm eyeballing that stock to determine where my stop should be. And that sounds a little elusive, but it's really not. With a little practice and common sense, I think you can do the same. So use these statistics if you want to, but I would take them with a grain of salt. So again, common sense is your best friend. You want to eyeball it. Don't overthink it. Sometimes I'll get into an email thread with someone where they go back and forth and back and forth and back and forth. It's like, look, it's bouncing around 2-3 points a day. So just make sure you're outside of those 2 or 3 points. And then again, what's the least amount of room I can give the position and have it still work? I say again, I don't know if I said that. I said it last week, I think. What's the least amount of room I can give this position and have it still work? And then maybe go just a tiny bit outside of that volatility. Now, if the HV is 150, 200, 300, then it's too crazy, okay? With volatility, you also need structure before you can take a trade. You don't just trade a volatile market. You trade a volatile market or a more volatile market as a general statement that also has structure. So if you read that article, Better the Devil You Know, in the article I said you need 3 things, kind of like location, location, location of real estate. You need structure, structure, and structure. By that I mean a pattern plus trend qualifiers such as acceleration of that trend, persistency of that trend, gaps within that trend in the direction of the intended trade, and not the opposite things, okay? You can look at it 2 different ways. I prefer to look at the positive side. I was going to be a pessimist, but I figured it wouldn't work out. But it's kind of like the counterfeit currency detectives. They don't sit around and look at a bunch of orange small monopoly money and say, yeah, it's a fake. Oh, it's another fake. It's another fake. No, they study the genuine article very carefully. They study the fibers on it. They study the little, I guess the bigger bills have the tape in it. They study, I don't know a lot about currency other than I like it and I collect it. But there's a lot of little things that make up that genuine dollar bill, and they study that. But in trading, you should study success, but also be able to recognize when something is not right. And the best way to do that, is what I'm trying to say, is to study stocks that worked and worked well. Now, I kind of got a little ahead of myself with the stock selection thing, but if you're getting stopped out a lot, as I often say, you're doing 2 things wrong. One or the other, and probably a combination of both. You need to err on the side of being a little looser with your stop. And I say this almost weekly. I fix a lot of people. I don't get paid to do this. They'll call me up and they're like, Dave, I'm having trouble. We can stop that a lot. Loosen your stop. Oh, okay, Dave. Hang up and they're fixed. That's all it takes. Now in some cases, like I said before, people call me 20 and 20-something times being stopped out in a row 20-something times. And I'll say, well, let's back up a little bit. Unless your stops are super, super tight, maybe your stock selection could use a little work. Now, this is the open portfolio. And this one just stopped out at a gain. And we didn't get the huge loaf that we wanted. We didn't have huge gains on the second loaf. I worked with a hedge fund years ago, and they always called things a loaf. Yeah, like a half a loaf, a full loaf, or whatever. And it stuck with me, and I never got that out of my head. People always email me, Dave, what's a loaf? Well, like I guess like a loaf of bread. You know, you eat half a loaf and then you keep half a loaf. So the second loaf or the second half of the trade didn't really materialize, but it made 1%, and 1% is not a bad trade. Plus another 1% and change in the first, so that's a 2% gain in the account. Better than the poke in the eye. Okay, so that one would come out. Now, in these other ones, you could see on the first loaf or first half. I got to stop saying loaf. It's confusing, I guess. We're looking for that 1,000% or 1,000%, $1,000 gain or 1% gain. It's $1,000 based on a 100K account. Okay. And then hopefully some multiple thereof on the second loaf or the second half of the trade. And so far, so good on the rest of these. And this one's could be a little better, but hey, better than the poke in the eye so far. So that's what good stock selection looks like. I can't promise you it'll always be 100% like that, correct? I guess if I could, then you'd never see my fat ass again. So there will be losses as I preach. In fact, what are we talking about today? Stops. But stock selection goes a long ways towards your money management. Everything's intertwined. Money management will cure a multitude of sins. But if you're getting into better stocks to begin with, I was talking to a client last week who struggles quite a bit, but he's getting it. It's taken him a few years. He started to get it. And he said, Dave, I get it. I got these big winners in my portfolio now, and I had a losing trade last week, and guess what I did? I got out of it. Because, why? Well, that losing trade is not doing you any good. Provided it's hit the stop, you have to exit. If it hasn't hit the stop, just leave it in there and let it work. But the point he was making is it was much easier to get rid of that losing trade because he knows what a winner looks like, and he's got a bunch of winners in his portfolio. It's kind of like, no place for losers. It's winners only. I was going to make some Donald Trump jokes, but I guess it's huge. So the point is, it makes it a lot easier once you start getting some winning trades. Once your stock selection gets better, then your mentality gets better. So that's the trading psychology part. Then your money management gets better because you're fired. It's like you're getting rid of those bad stocks in your portfolio. I did the column last week, make your portfolio great again. So check that one out too. When you get to my website, go to recent commentary on the content, or just go to random thoughts on the homepage. So anyway, good stock selection is often your best defense when it comes to these things. Now, I want to show you an example here of taking partial profits, but in this particular case, it was also an example of using discretion and why you should have used discretion even though it worked out without. So this was one that I showed earlier in the portfolio, and you can see that once again the stop was fairly wide, but that's what it called for. If you look at the size of these bars in here, they're pretty big bars, and if you look at this run from here to here, I don't know what that is, round numbers, but that's probably a 50-something% run, 60% run, maybe more. So even though that stop looks a little extreme, given the nature of the stock, it's really not that crazy. And then also, like we talked about last week, first question, where would you be absolutely positively wrong? Well, if this stock triggered, it went down to brand new lows, then you're absolutely positively wrong. So where would a stop be where that position would be becoming a failure, okay? So it's an absolute failure here, and if this is fairly close to this, then by all means put a stop way down here. But if it's a long ways away or a fairly long ways away like this, the next question is, well, where would a stop be to ride out this normal volatility, and where would a stop be to be a failure? Where would the position be a failure? I'm sorry. So if it made it all the way back down to here, then there's probably a good chance that it's failing and could go to here. We don't know for sure, but based on the volatility of the stock, we have a stop set way down here. By the way, on that prior stock that had an HV of 91, I guess it's like incest. It's all relative, right? So 91 compares to the S&P 500, which is at 14 right now. So that stock was CNX was 6.5 times more volatile than the S&P 500. By the way, you're never going to beat a market by trading stocks that are less volatile than the underlying instrument that you're trying to beat. You can't trade stocks with an HV of 10 and plan on beating the S&P, which has an HV of 14. Okay? It's just not going to happen. The only way it will happen is if the volatility of the stock you're trading increases to greater than the volatility of the market. Now, there's a few aberrations that could happen here and there, but that's the exception and not the norm. As a general statement, you'll never beat a market with stocks that are less volatile than the overall market. And by the way, again, better the devil you know. Let's not digress too far, but with a lower volatility stock, something bad could always happen. The CEO can still do some bad things, okay? Humans aren't immune to doing things that they should not do, okay? Now, getting back to this stock here, we had the initial profit target, and it was at like 820, and it got to 818. And my point, I think that's a couple of weeks ago, was that's close enough for government work. Okay, don't split hairs. When you see it get really close like this, and especially, not that you should watch a chart intraday, but maybe you could have your phone give you an alarm if you're getting close to that profit target. 95 to 99% of the time, there's nothing to do with the trade. And if you're trading my way, it could be quite boring because all you do is sit back and wait. Wait for positions to work or wait for new setups, okay? But every now and then, it wouldn't hurt to have that phone set up around, let's say, I don't know, $8 a share, or maybe even $7.90 or something, so your phone beeps and tells you, hey, your stock's getting close to that profit target. I might need to take some action. Well, I got a lot of emails from clients after this who didn't take profits, and then it backed off intraday. And then, well, now what I do? Well, like I said last week, you can't let yourself make too many decisions. So your decision would have to be, if it gets close to 820, then I'm going to exit. I'm not going to sit around and wait. And then next day, of course, it lapped lower. Kind of it's a gap that was within the prior range, so they call it a lap. It overlaps the range. And then it sold off fairly hard over the next couple of days. And I was worried that this was to turn into a losing trade. And this would be my example of why discretion is necessary in trades. But luckily, it did come back and then closed above the profit target. Not only hit it, but closed above it yesterday. So this is what I call smoke them if you got them. You want to take that partial profit off and then leave a portion of the position on for hopefully a long-term gain. Okay. I know I kind of went around the corner with a lot of this stuff, but does that make sense? I guess I came in today thinking that we would talk about statistics, and then as I got into it, I realized that really I'm just eyeballing the charts, and you should do the same, and maybe use that HV as a little bit of a gauge to give you a feel for things. And the only thing that I can't give you is the experience. I could certainly reduce that learning curve by showing you how to pick the best stocks, but it's still going to take a little experience in looking at the charts and comparing them to their HV and then possibly the HV of other stocks, and then seeing how the stocks move, okay? But again, it's a general statement that HV of over 100, that's going to be a pretty crazy stock. So look at that very carefully before you take the trade. I don't willy-nilly trade stocks that have that high HV like that, but that's all we had in the energies Plus, they also had really good structure. They were beat up longer term, coming down from extremely high levels and bottomed out over a long period of time at low levels. Ditto for the metals and mining, maybe even more extreme with the metals and mining, like the CNX we talked about earlier, which is, I think, metals and mining and energy combined. But anyway, those stocks were super volatile. The other thing we talked about is, and I think this could be fodder for another show, speaking of those metals and minings and energies, is that I guess this week's show is going to be random thoughts, weekend charts. The program not going correctly at the beginning kind of threw me off a little bit, kind of iced the kicker here. But as this aforementioned client pointed out, he's like, you were going after those energies a year ago, and it didn't work. And I'm like, good job, you noticed. Thanks for noticing. I'm glad you noticed that. And we went after them because we had a setup. They didn't work. So what? Stopped out. Fortunately, a lot of them didn't trigger. But I know we went after the underlying commodity, USO, and that triggered, rallied up a little bit, came back in, stopped out. So what? You have to, when you see the chance, you have to take it. So anyway, I'm kind of all over the place, and I apologize for that. IPOs. This is something that's kind of surprising me. Is I keep thinking like, I need to do an IPO service where I go through the IPOs daily and do like what I do with the stock service and pick them and do that. And I do pick some of the more liquid ones and put them into my trading service. And one of those, trying to think one recently, the NVTR that's in there is an IPO. So what's amazing to me is this IPO bull market keeps going like the Energizer Bunny, but it's become very, very more selective. And the good thing is the good guys stand out like a sore thumb, stick out like a sore thumb to the bad guys. And again, learning how to recognize the best stocks is important. And that's through a combination of the stock course and then the IPO course. I got into that pretty heavily because the IPO course was originally part of the stock course. If you do get the stock course, now I'll throw in the IPO course if you want to do that. But there are still some good-looking IPOs out there. You just have to work a little harder at doing it. Anyway, so you check out my website on that. I'm still working on the website a little bit. The Fast Track special was messed up last week, but I did fix that. The IPO course threw it off. So if you go into Fast Track on my website, you can get everything for over half off, and then I'll give you 2 hours of my time on that. All right, let's hop into the charts. All right, let's take a look at the overall market first. Let me just get this chart set up. I was wondering why I wouldn't get any questions. Let's see. Okay, let's do this real quick. Let me get an update and answer this question. Okay, Donald says, this may be considered off topic, but I remember you revisited your 220 EMA breakout system from your Task magazine article and programmed it in the trade station. That was technical analysis of stocks commodities, 1996 was when that article was first published. It seems like yesterday. That's a long time ago, isn't it? By the way, I have an interview out in this month's technical analysis stocks and commodities magazine. So check that out in the May issue. Okay, a program in a trade station. From our preliminary analysis, the strategy does not work well in equity indexes. Absolutely. It does not work well in equity indices. And the reason it does it is because those are efficient markets. This was actually designed on more inefficient markets. And I was using it on the dollar or yen, and it worked really well over an inefficient period of time when the yen was very inefficient. But it will work, but you need to be in more inefficient markets, and that's one thing that I probably didn't fully grasp at the time, because at that time I was focused a little bit more on commodities than equities. and I was doing doing a lot of the programming of the systems and all. And then I got back heavily in the equities and all around that time too. But uh, so you're right about that, absolutely. But seems to do much better with commodities. Perhaps this is to do with the mean reverting tendency of the equity indices. Your comments and thoughts on this, please. Yeah, Donald, you answered your own question. Equities are very choppy. I would imagine that this is working out well in commodities right now because commodities such as the metals and mining are making these very inefficient moves. The dollar has been weak as of late, and it's been helping to boost those areas higher. That's one of the things that's helping along. Plus, they've been so beat up that it's beginning to come back. I don't trade it directly, at least not anymore. Let's just, for S&Gs, put it into, let's put it in oil and see what happens. Now, oil, again, is going to be a more inefficient market, but they can make efficient moves. So you would have had, let's see, you would have had a buy right there. And you could say, I don't know whether that worked or not, maybe with money management, but then you'd have another buy here. So it'd have been a little choppy so far at oil. And then, let's see, 1, 2, you'd have another buy here. So depending on where your stop was on your original trade, I don't know if you'd still be in that, being able to ride out that thing. But yeah, what you have observed is correct. Inefficient markets such as small cap and speculative issues. Yes. Yes. I mean, for instance, take a look at the portfolio. Oops. Those are a combination of small, most of them are smaller cap, but some of those energies are pretty big in there or can be big. But here is an IPO, and it's made a pretty inefficient move. As you can see off the lows, low to that little peak in there, that's 100% move, okay? You're not going to get that kind of move in an index. So, yeah, look at this. Here's an example. This is the 20-day exponential moving average. This was the trigger for us because we were playing this pattern here, this thrust from lows and this pullback. But your 220 EMA would have put you in on this day here because it's a two bar breakout above the EMA, and then you get in above that. And depends on where your stop was placed. If it was placed appropriately or properly, like I pointed out earlier, then so far you would have caught that pretty nice move out. So you could see these inefficient moves in these stocks. Let's just measure this from the lows. CNX, that's another one we're talking about, to this close here. That's 172%. So these stocks are pretty inefficient. By inefficient, I mean that those moves were not priced in. The AROC was just at the profit target. It's up 128%. So, yeah, definitely read that article on my website because that talks about the importance of inefficient stocks. Also, read that Stocks and Commodities interview because I talked a lot about inefficiencies and efficiency in there. And what I've found is through my travels, when I meet another trader, easy for me to say, who is talking about inefficiency and efficiencies of markets, I know that trader is pretty smart and understands markets. Not that I'm pretty smart or anything, but I feel like that was kind of an epiphany for me when I reached a point where I started really studying those inefficient markets. Now, efficient markets can make inefficient moves like those commodities you have witnessed are doing, okay? You just have to pick your spots really carefully. Forex could be a wonderful market that's efficient but can make inefficient moves. And the way you trade that is pick some sort of emerging trend pattern as opposed to generic trend following. And I think you do okay. 20 EMA on BTG in hindsight? BTG. Oh, you're welcome, Donald. Donald says thanks for your reply. Yeah, I mean, look at that. So these gold stocks, all these little small cap gold stocks, had some wonderful moves based on that little tiny breakout system I wrote years ago. The whole point of writing that system was not to say I want everybody to go out and trade this system. The point in writing that little system was I challenged myself to write a fairly simple system to show that you didn't need some big complex way to trade. Now, since then, obviously, I've learned to read the charts a lot better, and that's when I was kind of like the tail end of my mechanical testing phase back when that was published. But yeah, simple things could work. And then, as I often preach, everything works better with trend. So if you have a trend, all these little systems are going to work really good. So first thing is maybe recognize that trend first. Okay, let's hop into the overall market. And thanks again for showing up. We've got a really good turnout in spite of all the problems. So I'm really pumped up about that. S&P 500. This market's been really climbing the wall of worry. And boy, you can't confuse the issue with facts because you start looking at some of the stuff out there, and it's pretty scary. You know, printing of money, ISIS, world wars, whatever's going on, plagues. But so far, what's the S&P done? It's going up. Okay. Now, over the short term, we did have a little breakout from this range, and so far, it's kind of stalling out a little bit from that breakout, but I don't want to pick it apart too much because, as you can see, it's had a pretty nice run from lows. Now, if you back the chart out a bit, you can see that there's still a lot of trading just above where we are now, and we're just beginning to push into that. The problem with that is anybody who bought or anyone who bought during that range might be looking to get out of break even. Another way of looking at it, too, with overhead supply is that, let's say you're holding on to a market and the market goes sideways like it did here. And every time you check your portfolio, you're doing about the same. Well, I don't want to go back too far into psychology, but if you think about that, there is an anchoring mechanism that we have. You grow accustomed to your portfolio being a certain level. Let's just say it's $1 million, okay? And let's say you're an older guy and you're thinking about retiring on your portfolio, whatever. And every time you check it for the last year, it's been about $1 million, okay? Well, then you get a big drop here. It's only worth $800,000. Then you start getting a little nervous. Maybe I need to sell it. It comes back. You check it again. Oh, it's worth $1 million. I think it's okay. It's okay. And then what happens? It drops again, and it's worth $750,000. Like, oh, you know what? I might have to bail out. Oh, I'm back again. I'm just going to sit tight for a little while. I'm back. But, you know what? Maybe now that I'm whole again, might be a good time to get out. I don't want to live through that slide again. So that's the psychology behind a market. So if anybody buys during a range or even holds through a range, they may be inclined to get out at that level. Nothing magical about this form of technical analysis. It's just common sense based on the psychology of the market. So that's the problem with the P's. Longer term, we still have a sell signal on a weekly basis. Now, you can see that the bow ties are coming together again on a weekly basis, and actually it could bow tie soon to the upside. But this longer term high makes this bow tie trump this bow tie. So until this market makes new highs, this sell signal remains in effect. And this was way back last September. Now, obviously, the market hasn't cracked since, and I don't follow this signal mechanically, but it's in the back of my head that we have a sell signal going back to last year. Last September. Yeah, last September. Okay, so that's a while back. Let's take a look at the NASDAQ. NASDAQ, a little bit more obvious in its overhead supply. If you back the chart way out, you can see it's got a lot more trading right above where we are. And to me, so far, this just looks like a big picture retrace. But Dave, you got bow ties and things like that over here. Well, you do. But as I often preach, I would much rather trade a bow tie off of like a 10 or a 15 or whatever. How many year lows was that? 15-year lows in 2009? I would much rather trade a bow tie off of, let's see if we can find it. Wait for it. a 15-year low like this, then to the upside at least, then one that's at much, much higher levels. So this way back here was a very significant signal. And then those within the long-term trend are, to me, less significant. So an emerging trend has to be coming off of a major low or a major high for me to get very excited about. It doesn't mean that the trend might turn within the longer term trend and go up or down, whatever the case may be. In this particular case, it may go up, okay? But this signal is not as important as a signal that goes way back like in 2009. I've covered this quite a bit in webinars. I don't want to go too far into that. Let's take a look at the Rusty, which are all on YouTube now, all the newer ones at least from YouTube, last couple of years. Rusty, same sort of action. In the big picture retrace, a little more obvious here. The mountain of overhead supply, a little bit more obvious here. So anybody who bought over the last couple of years at a Russell is now underwater or close to being underwater or close to looking to get out, break even. So that's a problem. And it's a little bit more obvious when you look at a weekly chart, okay? Now, the other thing to remember, too, just since we're on a weekly chart here, one of the problems is that, and I was talking to one of you guys about this earlier, is that anybody who bought in 2009 is still holding on is kind of buying into the notion that the market always goes up longer term, which it doesn't, okay? So if this thing does begin to roll over in earnest, they're going to be a hurting pup. Anybody who bought somewhere in between is going to be a hurting pup. And then those who bought somewhere in this range because they finally threw in the towel and said, this market's going up forever, I better get in. So I'm still very cautious about the overall market. But Dave, you shorting stocks? No, because we're not really getting these short setups. We got stopped out of our last short yesterday, and now we have 100% longs in the portfolio. But most of those stocks are commodity related. The one that's not is a speculative issue that could trade contra to the overall market. The reason these speculative issues, one reason I should say, they're inefficient, and the reason that they can trade irrespective of what or contra or trade whatever, ignore the overall market, I guess is what I'm trying to say, is because the gross domestic product, I can't even say it, doesn't really matter for a little startup biotech or health service company, whatever it is, because they don't have any earnings, and the economy is really not going to make a difference. They don't have any earnings anyway. So all of those things get tossed out the window. And that's why I call the course IPOs the promise of the future, because you're trading off the promise of the future. You're not necessarily trading off the reality. I have no idea what that company does, NDTR, okay? And it might be the greatest, keep it with my my wheat theme, it might be the greatest company since sliced bread, okay? And it might turn out to be one of our great longer-term winners. And 5 years from now, I'm doing a webinar, God willing, and we're talking about it. But it might not. And right now, at least that short to intermediate term move is fueled by the promise, the excitement of the future. People who are buying into that, people who are drinking that possible potential Kool-Aid. I hope it's not potential Kool-Aid. I hope we get more than a short-term move out of it. But I'm prepared to be stopped out if we don't. All right, so I'm trying to explain the psychology of the market's participants. Let's take a look at some of these sectors in here. Retail came up here. It's close to new highs. But what I don't like about retail, it's kind of like the overall market. You've got a V-shaped recovery at high levels. Again, I would much rather a market be like, well, that's not going to work. I would much rather a market be at very low levels than at high levels like this when it makes a V-shaped recovery. And the reason is the market is already overbought by the time it gets up to the new high. So it's hard to mount a new leg on top of the old one. And if you study classical technical analysis, you know that you have double or possible triple tops in here. And people look to get out around those levels a lot of times. Now keep in mind that with something like a double top, Rarely is it going to shape up like this, where it just stalls right at that prior top. What usually happens is two things. One, it overshoots it, and then the market dies. And that would be the worst case scenario for the S&P 500, because that would trap in a lot of people before it imploded. And the other thing they do is they stall short of that prior high, and then they begin to implode. This is kind of like, I guess, the part of the theory behind my gatekeeper pattern. You're looking for that market to stall before it hits those prior highs. Now, some areas like semis have rallied up to the prior peaks, but they're still well below the longer term peaks in here. So it's really hard for me to get too excited about this market, at least just yet. You take a look at like the foods, and this is going to work nicely, dovetail in nicely with the utility argument here. And it dovetails in nicely with the argument about trading lower volatility areas. HV is only 12 on the foods. Notice that they broke out, and then they tried to break out even further. Now they're beginning to implode. So even though the volatility is low, the volatility is beginning to expand, and they're starting to act like a different animal here. So you can't take comfort in trading a lower volatility area. So speaking of utilities, let's take a look at that. Utilities, or look at that, low HV, and they're also an example of hitting that prior peak. What did I just say about double tops? A lot of times they overshoot. That's exactly what it did. But people who thought, well, I'm just going to put my money in some sleepy little utilities, what's happening now? Okay. Well, they're beginning to implode pretty hard. That volatility is beginning to expand. So just because you think you're in a safe area doesn't mean something bad can happen. And again, let's not back too far into this, because I know I've been on a lot of tangents today. But your position sizing on a less volatile stock, you're going to have to take on a really big position to make it worth your while. Go in and watch last week's Dave Landry's The Week in Charts when you're done with this one, and I talked about that quite a bit. Now, what's caused these utilities to implode? Probably the fact, or in part, I should say, by the fact that bonds are beginning to kind of, I wouldn't say come unglued, but it's selling off fairly hard in here. Let's take a look at the dollar. It doesn't take a rocket surgeon to see. Now, it's not a beeline, right? But you could connect the dots pretty easy. Let's connect this close to this close. It's all you have to do sometimes, right? And it's some oscillations above and below. If you're one of those scientific types, let's do this. Let's do a linear. That's not a linear regression. I'm trying to do a linear regression trend line. How do you do that? Oh, there it is. I don't use them. I played with them before, but so if you wanted to, you could do a linear regression trend line, and you can see that looks a lot like the trend line that I drew. So dollar's been headed lower as of late. If you wanted to get fancy and use one of those fancy bow ties I'm always talking about, let's do that, if I could find them. There we go. Okay, so on a weekly chart, you have a bow tie. It took it a while to form, but that's okay. And like I said last week or week before, or ad nauseum, as I often say, go in and look at markets when they make a weekly bow tie. You're going to be impressed. You're welcome off of major lows. Okay? When was the last buy side setup off of major lows in a dollar? Well, 2014. Okay? But Dave, you had one back here. Well, no, not really. It's kind of sloppy. And then if it did trigger, well, I don't know. Doesn't always work. But it usually pays to pay attention. And even if it doesn't work out exactly, that area becomes a good area to focus on as the top. So the dollar has topped until and unless it takes out this high. The stock market has topped until and unless it takes out its prior highs. Okay? So you don't necessarily want to rush out and short a bunch of dollars or short stocks or whatever market is making these longer term transitions, but you certainly want to pay attention to what's happening. And you certainly want to think twice, do I really want to buy a stock in general right now? And the answer is no. Well, Dave, you're mostly long. Well, it's because we've bought some energies and some metals and mining. Netflix, notice Netflix just kind of imploded in here. There was really no structure to buy it, but that's kind of a point of stocks in general, especially more efficient stock like this, can easily get torpedoed when the overall market is somewhat questionable. I don't know if that worked or not, but all right, let me just show you energies and metals and mining real quick, and we'll hop out into everything else. Start asking about individual stocks now, if you like. Just ask about one per line, and then hit return so I can make sure I get to everybody's questions. So let's take a look at the energy stocks. Energy stocks have a nice run from lows in here, as you can see. And they're right around these multi-month highs. So far, so good there. Metals and mining looking pretty good, too. In fact, metals and mining a little bit more extreme in their run from lows. And that's why we've been doing so well with these. All right, let's go ahead and open up for individual stocks again. All right, let's see. Susie wants to know about PTCT. PTCT, okay. Well, draw your horizontal line. You can see it's gone sideways for a long, long time. And then you got a big fat gap just above the market. And then what have we been talking about all day today? Volatility. Volatility is 268 on the 50-day HV. You need the formula for 50-day HV. I'll give it to you. I have it for Telechart. I have it for Metastock too, buried away somewhere. But when I programmed it in, I just got off the internet. So, but anyway, so just too wild and crazy. I hear what you're saying. Maybe it's bottoming out. It took off the other day, and now it's pulled back a little bit. But this move is kind of extreme, from 6 to 10 percentage-wise in one day. It's 4 points. That's even by Big Dave standards, that's pretty crazy. And even if it does begin to rally, you could have a mountain of overhead supply. I guess that's okay if it goes up to $20 and you're in at 10. But I think it's too risky. And there's really no structure there other than that one big up day. So I would avoid that one at all cost. Ken wants to know about ETE. Ken, you have a famous name. Are you that guy? I'll have to Google you. This one looks like it's bottomed out. I'm not seeing a setup just yet, though. Let's take a look at the bow tie on that one and see what comes up. Yeah, I hear you. It's bow tied. To me, it looks like, at least at this juncture, it'd have to follow through a little bit, but then look to play it on a pullback. Yeah, I'd keep that on my momentum list because this is one of those fallen angels. It was up at, what, $30-something a share, and now it's at 10. It's not jumping out at me as a setup that I'd want to take today. The volatility is a little crazy. I was getting ready to point out this wide range bar here. It's got to be a little nervous. Volatility is at almost 160. That's pretty extreme. So I would wait to see if it could break out a little bit more, then maybe look to play the first pullback there, with the caveat that this is almost too crazy at 157 on the HV. All right, Richard wants to know about BTE. That's going to be oil and gas stock. Well, you had a nice little bow tie back here, and it should have been on my Landry list back then, I'm guessing. I'm guessing that it was. It's a little choppy, but that's comes with the territory of these oil and gas stocks. You've already triggered in the bow tie, so what I would do is wait to see if it could continue higher and then look to play the first pullback. And it is pretty volatile, as you can see, HV 95. MU for Terry, I'm probably not going to like that one because it's a big fixed stock. It's Micron Technologies. Let's draw we're trend followers, so let's just connect the dots. And looks like it's going sideways in here. So there's nothing for me to do with the stock that looks like this. But if it could get its act together and begin to rally off those lows, then maybe the tune might change. But then if it does, it's got a mountain of overhead supply. So I would avoid that stock. I tend to like to short more efficient issues and buy more inefficient issues. Remember, we shorted OZRK, which just stopped out yesterday. That's a bank that has tangible, quantifiable, tangible fundamentals, however you want to look at that. S'il vous plaît. For Netflix. You want to look at Netflix again? No, there's nothing there to trade. I mean, if anything, looks like it could be the mother of all tops forming, but it's so wide and loose and all over the place. Let's take a look at a weekly chart just for S&Gs. Maybe that has a little structure to it. Yeah, I mean, this, boy, I tell you, it looks like a stock's in a lot of trouble. But it's kind of wide and loose, and I don't really see a way to kind of get into that one. But long or short, yeah, I certainly wouldn't buy it. I think a short side would be the way to play. But I like the last flag of the daily. Oh, I hear you on that little volatile one. Yeah, the problem is it's a flag off of a big one bar pattern. In IPOs, I call that a flagpole, and it could work. Those could work fairly well. But we're not talking IPOs here. We're talking established issue. The rules are a little bit different with the IPOs. BCI looks pretty good, but it's not set up. You have to wait for a pullback. But look at the volatility. 239, I think I'd probably just pass on that one. That's a little bit too crazy, even by my standards. But you got your bow tie, so you'd have to wait for a pullback. But, yeah, if you did take that one, be prepared for a bumpy ride. The other problem is, and it might be a good problem to have, is you've got a lot of overhead supply. By a good problem, I'm saying that if it rallies up there, you've got so much profits you don't care. But no, that's too close. So I would avoid that one. Volatility, overhead supply, a lot of reasons not to take this trade. Okay, Arseny wants to know about ELNC. Arseny. ENLC. Okay. Yeah, it looks like it's bottomed out. You had your bow tie somewhere back here, maybe on a pullback. But yeah, it looks good. I mean, I've got a plethora of these energies on my watch list. Iron Condor, I've never seen an Iron Condor fly. They're just too heavy. Oh, an options position. Oh, okay. No, I'm not a big fan of condors and iron condors and all these other things. Butterflies and options and things like that. The problem is your window for profit is just too small. I'm a trend guy. I'm a trend follower, so I believe in following the trend. Now, it's not my way or highway. If you could take my trend following information and mantra, however you want to look at it, and factor it into what you do and make what you do even better, then I'm very flattered. I'm glad you did that. In fact, I'd be even more impressed that if you did that as opposed to everything I do on more mechanical basis. So, but yeah, I'm just not a big options guy. Too many moving parts. I'm willing to bet you're an engineer. Karen wants to know, is that IBN? Boy, my eyes are gone. Let me get my glasses on. I need to IBN. Put your caps lock on. Yeah, it's a bank. It's a foreign bank. It's kind of bow tied in here. It's got some problems along the way. So I don't know if I'd rush out and buy this one. It's kind of hard to get too excited about a bank, but it's got an okay HV around 50. Yeah, I think I'd probably pass on this one, but I hear you. It's bottomed out, maybe on a pullback. Netflix butterfly. You mean butterfly like you want to trade a butterfly, or you mean like a butterfly pattern? I don't trade either one, the butterfly or the butterfly options. But yeah, bigger picture, I'm sure it's some sort of big picture pattern. I don't trade the butterfly though. To each his own though. Maybe it's something you find worthwhile. You have to find something that makes sense to you and stick with it. And for me, I tried a little bit of everything, and I came back to this simplified technical analysis. That's why I bought the trademark, Trading Simplified. This stock's breaking out to new highs in here. So maybe there'll be some pullbacks along the way, but right now it's not set up. But yeah, if it could continue to follow through, it's a little wide and loose. But if you can get its act together, because so far you do have an acceleration of trend. Notice that the trend kind of gradually worked its way higher, and now it's beginning to push higher in a more aggressive stance. And then it's also taken out some of this resistance in here and taken out prior peaks. So maybe on pullbacks for that one, Gary. ELNC for Arseny. Let's see. ENLC. Did we talk about this one? Yeah, it's kind of working its way higher. On next pullback, maybe it might be worth a shot. ARGS for Donald. Okay. The problem with this one is it's shot from 6 to well over 12 over like a short period of time. And let's see how many bars that is. Just let's look at this little tiny move in here. Yeah, it's like 60% in like a couple of days and then 100% over like a week or so. That's what I call a bottle rocket. It's a little too crazy for me when they do that. And then you have a gap down. So gaps, as a general statement, usually a gap against a trend, unless it's in a commodity-related area that's prone to gapping, meaning that the stock has an underlying commodity that it tends to be pushed around a little bit by, like the energy stocks. I'm okay with a little bit of a gap in energies, and I'm okay with a little bit of gap in metals and mining, because the commodities being efficient, the underlying commodity being efficient, can gap around a little bit, push the market around a little. But in a generic stock, I don't like a gap against a trend. And then the HV is kind of high in here. We're over 100. So the red flag should go up anytime your HV is over 100. And then you have to really begin to pick apart the setup. But this thing has gone from, what is this down here to here? Okay, it's up 550% over a relatively short period of time. It's just too crazy. And then also the volume slightly low. Not that I wouldn't trade a stock with 300,000 shares, but if you factor all this together, it's just too crazy. So, did you cover Facebook yet? No, Harry, you're not going to see it as a general statement. Facebook, Netflix, and those stocks, as a general statement, you're really not going to see them too much in these presentations because they're bigger, more efficient stocks. And the only time you're going to see them is if I'm talking about them possibly break it down or something. But notice that it was down and then it gaps higher and then it gives up it shoots higher and then it gives up all those gains and then it takes off again and then it gives up and then now it's trying to take off again. It's a Jackie Mason stock. Maybe it's a good stock for an iron condor. You'd probably be in the money at some point in the month, every month, right? Too crazy. DBA, that's going to be an ETF for the ags. Okay, the question is a bow tie? Well, it was a bow tie, but it never really materialized, and now it's trying to go back up again. So it could be a longer-term, bigger picture bottom. You got a little bit of overhead right here, but it's not too scary given the fact that it's commodity related. I'm not a huge fan of ETFs. There's certain cases where you could use them, and you might even see, but Dave, you recommend ETF every now and then. Well, yeah, I do. There's certain cases where you use them possibly to gain exposure to an area while you're looking for more inefficient stocks, but ETFs tend to be more efficient. Also, speaking of efficiency, look at the HV on this. The HV is 9, so it's pretty small HV. And look, we're looking at a move from here all the way to here. That's $1. So it's the volatility is too low for me to touch this. I mean, the only caveat I would say is maybe if you were bullish on commodities or bullish on the ags longer term, and you wanted to take a longer term position and say, okay, I'm going to stop myself out if it goes to new lows and just close your eyes and forget about it, then maybe I'd say, yeah, it's okay to do something like this. But what you might want to do if you are going to take such a position is wait for it to make a bow tie up and then put it in a longer term position and then just forget about it, okay? But yeah, HV too low. GPL, that's going to be a crazy silver stock. I think that's something Panther, right? GPL. Great Panther Silver. Yeah, it's becoming kind of crazy. Maybe on a pullback, but that's a pretty crazy one. Although the HV doesn't think it's that crazy, but it's just eyeballing it. It's a pretty crazy stock. But yeah, on a pullback, possibly, but it could be a dangerous ride. Silver is always a crazy area to trade. ARGS, did we cover that one? Yeah, we covered that one. That's that crazy biotech. Okay, any more? While we're in impasse, obviously I want to thank everybody for coming. I'm sorry about all the mix-up today, and hopefully that won't happen again. I know what happened. I'm just going to have to work out the details, set it up again properly. Anyway, I don't want to digress too far on that. As usual, I want to thank everybody for coming. Have a blast doing these shows. Any last questions? Going once, going twice? All right. Well, thanks again for showing up. If anything unanswered, shoot me an email, dave@davelandry.com. Either I'll answer you directly, or if it's an answer that requires a lot of thought, it'll be fodder for next week's show. If we don't talk again between now and then, everybody have a fantastic weekend, and I'll see you guys again next week. You're welcome, Matt. You're welcome, Leon. You're welcome, John. Thank you so much.